Hello everyone, and welcome back to the channel where we demystify the world of short squeezes and hard to borrow stocks. Today, we're diving deep into a fascinating microcap name that's recently popped up on our screeners, SGLY. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about SGLY. While specific sector information isn't available for this one, it's firmly in the microcap category, which often means higher volatility and unique dynamics compared to larger companies. The estimated float for SGLY stands at approximately 7.3 million shares. Now, when we look at recent price action and volume, the numbers are quite striking today. SGLY has seen 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Similarly, today's trading volume is 0 shares, with a 30-day average volume also at 0 shares, resulting in a relative volume of 0x average. Now, you might be thinking, why are we talking about a stock with no recent price movement or volume? And that's precisely what makes SGLY an interesting educational case for understanding the hard to borrow aspect, independent of current trading activity. What is cost to borrow and why it matters? Before we get further into SGLY, let's quickly recap what cost to borrow means for our newer viewers. When you short a stock, you're essentially borrowing shares from a broker to sell them, hoping to buy them back later at a low price for a profit. To do this, you pay a fee, much like interest on a loan. This is the cost to borrow, or CTB. It's an annualized rate. When a stock is hard to borrow, it means there's a limited supply of shares available for shorting. This scarcity drives the cost to borrow fees sky high, sometimes well over 100% annually, as short sellers compete for the few shares available. Why this stock is hard to borrow right now. And this brings us back to SGLY. Despite the current lack of trading volume, our screener flagged SGLY due to its absolutely massive annualized cost to borrow fee, which is currently sitting at an astonishing 720.1%. Highlight CTB that is an extremely high number, indicating a severe scarcity of shares available to short. Our internal composite squeeze score, which factors in CTB, float size, momentum, and technical setup, currently stands at 40.5 out of 100 for SGLY. While 40.5 isn't the highest we've ever seen, a CTB over 700% is always worth noting, even if there's no immediate momentum. The current availability of shares to borrow is unknown, but a CTB this high strongly suggests it's very low. Squeeze mechanics explained. So, how does this high cost to borrow relate to a short squeeze? Imagine this, short sellers are paying over 700% interest per year just to keep their short positions open on SGLY. If the price of SGLY were to start moving up, or if the supply of borrowable shares dwindled further, those short sellers would face increasing pressure. They'd be losing money on their short position as the price rises, and they'd be bleeding money daily on those exorbitant borrow fees. At some point, this pressure can become unbearable, forcing them to buy back shares to close their positions. This forced buying creates more upward pressure, which can trigger more short sellers to cover, creating a cascading effect known as a short squeeze. Now, it's crucial to remember that a high cost to borrow alone does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will eventually fall, and they're willing to pay dearly to maintain their short position. Dilution risk check. Next up, let's talk about dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can weaken a short squeeze thesis because more shares means less scarcity and less pressure on short sellers. For SGLY, we performed our dilution risk check and found no recent dilutive SEC filings like SGLY1s, SGLY3s, or 424 BS in the last 90 days. This means that, at least for now, there are no immediate signs of the company significantly increasing its share count through new offerings, which is a positive factor for a potential squeeze scenario. Recent reverse split watch. Now, this is an interesting and important detail for SGLY. The company executed a 1-for-14 reverse stock split on July 27, 2026, which was 28 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For instance, if you own 14 shares after a 1-for-14 split, you'd own 1 share, but its price would be 14 times higher. Reverse splits reduce the float, which can sometimes amplify volatility. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split. This is a pattern we've observed in some names, not a guarantee, but it's certainly something to keep in mind, especially for SGLY given its recent split date aligning with this approximate timeframe. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should we watch for with SGLY given its unique profile? The extremely high cost to borrow of 720.1% is the primary signal here, suggesting significant short interest and difficulty in obtaining shares. Keep an eye on any changes in borrower availability or the cost to borrow fee, as this can be an early indicator of increasing pressure. Also, considering the zero volume and price movement, any actual trading activity, even small, could be significant due to the tight float and high CTB. And, of course, the recent reverse split and the historical tendency for post-split volatility in microcaps makes this an interesting setup if and when volume appears. SGLY presents a fascinating case study in the hard-to-borrow universe. While current price action is non-existent, the underlying mechanics of its 720.1% cost to borrow and its recent reverse split make it an educational example of how extreme borrow fees can exist even in quiet periods. Remember to always conduct your own thorough due diligence. If you found this deep dive into SGLY and the world of hard-to-borrow stocks insightful, please hit that like button, subscribe for more unique stock analyses, and let us know in the comments what other stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.